Everybody's having a great day. It is like 20 degrees cooler than what it was 2 days ago. So it's a cool wave coming through. So I hope everybody's enjoying their summer so far. One question we've been getting a lot just over the last really 18 months to 2 years coming out of the pandemic, and really people have heard about the Secure Act a lot, is there's been more and more questions about required minimum distribution. So client at actually our last webinar we did said, hey, can you do just a 20-minute webinar on what a required minimum distribution is, how it works, things that we need to be, aware of, and so forth. So I've got a presentation. It'll probably go 15 to 20 minutes. If anyone on here has a question at all as we go through, on the bottom of your screen, there's a Q&A button. So you can push that button and you can type in any questions. Jenna's also on the webinar here with us. She'll be able to see those questions and can get them relayed to myself, and we can address them. So I want this to be very interactive as well. If you have questions or examples or scenarios that you'd like me to go through, I'm happy to do that. So today we're going to be talking all about required minimum distribution. So 3 things that I want to cover specifically when looking at those are: what is it? And why do we have to take it? That's a question we get all the time, right? Why do I have to spend my money or take a distribution even if I don't want to? Number 2 is, how does it work, or how is it calculated, is a common way of putting that. And then number 3 are just some takeaways or things that you should be aware of when thinking about, required minimum distributions, preparing for those, just things that you need to consider that I see a lot of people fall short on as we meet with those. So let's get started, right? So number 1, what is it, right? When you look at an RMD, I do not expect you to read this slide, okay? This is directly off of the IRS website of what a required minimum distribution is. Basically, RMD stands for required minimum distribution. So what that refers to is your pre-tax assets. So if you were working, for example, for 30 or 40 years, you were probably putting into a 401k. And those contributions that you put into the 401k were pre-tax, meaning they were coming out of your paycheck before you paid taxes on that money. And then ultimately, they would continue to grow tax deferred each year until you take a distribution, right? So ultimately, you've got this pile of money, or this sum of money that's been growing tax deferred all these years. And what a required minimum distribution is an actuarial spend down of that money. So the IRS says, hey, you've lived long enough. You've got enough tax deferred growth on this, and we're going to force you to start taking some of that money out each year just so you can pay taxes. So literally, it's a spend down of your money so you pay taxes, and then ultimately they don't care what you do with that money after the fact. If you reinvest it in an after-tax investment, if you spend it, if you gift it, they don't care. They ultimately just want their tax dollars from that. So one thing just to note, right, if you reading this page, it used to be that the required minimum distribution age was age 70 and a half. And some of you on this webinar had to start your required minimum distribution at age 70 and a half. When the Secure Act passed in 2019, they moved that RMD age back to age 72. So for today's examples, I'm going to use the examples as if we were post-Secure Act. So basically looking at the numbers after the Secure Act, okay? Just know with a required minimum distribution, they're only looking at pre-tax money. So only IRAs and 401ks that are pre-tax, okay? They would call it a traditional IRA or a traditional 401k. There is no required minimum distribution on a Roth IRA. There is no required minimum distribution on a trust account or a joint account or a brokerage account. Anything like that is after-tax money, and you're not forced to take a required minimum distribution from it. Only the IRA. So you can see a list up here: IRA, simple IRA, SEP IRA, or retirement account, right? So those would be non-Roths that they're referring to. So what happens when you want to start calculating a required minimum distribution? This is a question that we get from people all the time, right? How do you calculate it? How does it work? So when you reach the age of 72, the IRS gives you a life expectancy, and they call it a uniform lifetime table. If you Googled it, this is exactly what would pop up. So you can see on the far left here, attained age. So the required minimum distribution starts at age 72. And you can see the distribution period or life expectancy is 27.4. Every year you get older, that distribution period or life expectancy gets a little bit smaller. All they're doing is taking the age of the year that you're in. So if you turned age 72 this year, they would take your December 31st account balance for any of your IRAs, and they simply divide it by your distribution period or your life expectancy. And I'll give you some real life examples here in just a second. The reason I pull up the uniform lifetime table is ultimately I want you to just notice that the older you get, right, the smaller your life expectancy gets. So something you need to be prepared for is just the older you get, the bigger distribution you're forced to take from your IRAs. And it goes back to that tax question, right? The older you get, the shorter your life expectancy, you have a less time period to take that money out and pay taxes on it. So that's why it's accelerating, right? They want you to take those distributions to pay taxes. If your life expectancy gets shorter, divide a number by a smaller number, you have to take out a bigger percentage. So just know when you're factoring in a required minimum distribution, it really just comes down to what age you are and what distribution period you're in, right? So let's look at a real life example of this, okay? Let's assume a client's name is Mary and she's turning age 72 this year, okay? So she's just turning age 72. Let's assume that Mary has two IRAs. So she might have an IRA with, $700,000 in it. And then she might have an IRA with $790,000 in it. So her total pre-tax bucket is $1.49 million. Okay. And I want you guys to notice on here that I put the December 31st value. That's important. Okay. So a lot of people say, well, why is December 31st important? When factoring in the required minimum distribution, you have to look at the preceding year end value. So for example, if we're in 2022 right now, the preceding year was 2021. So we use the account balance as of December 31st of the preceding year. So Mary's accounts, for example, in IRA number one of $700,000 was the balance as of December 31st. Same thing for the $790,000. So the IRS does not care if you take all of your required minimum distribution from one account or a little bit from each. And I'm going to repeat that because it's important. Okay. You notice that I put the total amount in IRAs below. We have to use the total amount to factor the required minimum distribution. Okay. Your life expectancy, or as they said before, attained age, right, ultimately is going to be the same on any figure that you have because you are what you are. You're age 72 in this example. So all we would do to calculate the required minimum distribution for Mary is we would take the total amount of IRA balance as of December 31st, and we would divide it by her life expectancy, that 27.4. So going back to our uniform table, you can see that if Mary's age 72, her distribution period or life expectancy is 27.4, and that's where we inputted that number. So divide the December 31st total by your life expectancy for the age that you are, and ultimately it gives you the total required minimum distribution that you have to take out by December 31st of this year, right, of 2022. So you can see in this example, Mary has to take a total required minimum distribution of about $55,000, right? $54,379. So that's how much she has to take out by the end of the year. Okay. So when we look at this, some clients will say, well, I'm only taking distributions out of one account. I'm just going to repeat this. You can take distributions, you can take all $54,000 out of one account, or you can take some out of both. The IRS doesn't care which IRA you take it out of because there's a 1099 that's generated, and all of that information goes onto your tax return. All they care about is that you're taking the total required minimum distribution that's necessary to satisfy that. Okay, so you just have to take the total. You don't have to take it from each account. It just has to be enough that it equals the sum that's necessary to come out for that year. Things that you guys should be aware of. Okay, and there's quite a few here, so I'm going to spend quite a bit of time just going through this. The first year you take a required minimum distribution. So in this example, the first year that you would take a required minimum distribution would be age 70, right? So I'm going to do a little writing on here. Excuse my penmanship, or excuse me, it would be age 72, right? Post-Secure Act, your first year of taking a required minimum distribution would be age 72. In the first year that you're taking that RMD, right, you have the ability to delay your payment until April of the preceding year. So for example, if you turned 72 this year and you said, you know what, I don't want to take my RMD, you don't have to, okay? You can take that RMD amount out before April of the next year, okay? So before April of 2023. Now, there's a catch to that, as there always is, right? If you said I wanted to delay my RMD until 2023 and take my age 72 RMD, you also have to take your age 73 RMD in 2023. You don't get to skip a year. What they're doing is the IRS is saying you might still be working this year. And if your income bracket is higher and you want to delay your RMD until next year when your income bracket might be lower, you can do that, but you still have to take the RMD out that you should have taken this year, and you have to take the RMD out as if you were age 73. So you don't get to skip a year, you actually have to take both. And very rarely do we see someone actually delay their benefit until the following year, unless it's the scenario I just described. Unless you're working, right, and you have a high income bracket during that year, and we're looking to do some actual tax planning behind it, typically we would take your RMD at age 72 and take your RMD at age 73 and every year thereafter, because if you're double dipping your RMD, right? So in Mary's example, if she has to take out $54,000, right? That's two distributions of $50,000+ she'd have to take. And now all of a sudden she's showing over $100,000 of income in that scenario, and she's going to be in a higher tax bracket. So very rarely do we see anyone take advantage or utilize that unless they're working or in a high tax bracket for that given year for some scenario. Everybody's different. If you have more questions or any questions on that, I'm happy to go through those with you very much in detail, but ultimately, very rarely do we see that utilized. One thing that everyone should be aware of is just tax planning when it comes to required minimum distributions. If you said, of all the things that I'm talking about, right, what is the one thing that people fail the most? It's planning on their taxes when it comes to required minimum distributions. Okay. So the way the tax code works, and I'm going to use Mary because I've been using her as an example. So I'm going to use Mary as an example here again. And I'm going to pull this up. So if Mary's a single woman and we look at the tax brackets of single filers, And you can see here, taxable single. The first roughly $10,000 that Mary makes is taxed at 10%. From roughly 10,000 up to 40,000, it's taxed at 12%. You can see from 40,000 to 86,000, it's taxed at 22%. And then from 86,000 to 164,000, that income would be taxed at 24%. They call those marginal tax brackets. But ultimately, the first 10,000 she's making is only taxed at 10%. And the difference between the 10,000 and 40,000 is taxed at 12, and so on and so forth. So ultimately, when you look at this, in this example, let's say that Mary had a pension that totaled $50,000. And if she was a teacher, for example, she wouldn't have any Social Security. She would just have that $50,000 of income that's coming in. Okay. So if we looked at that, that would put Mary in the 22% tax bracket in that example. So she makes $50,000 a year in her pension. She's in the 22% tax bracket. When she takes her required minimum distribution, right, at age 72, if she has to take out $54,000 because that's what she's required to do, right? 50,000 plus 54,000 equals 104,000. That puts her in the marginal tax bracket of 24%. So one of the things that Mary needs to be aware of is we know it's a certainty that she's going to be forced to take a required minimum distribution starting at age 72. Just like everyone else on this call, you're going to be forced to start taking distributions at 72 if you haven't already. So that means any distribution you take is going to be taxed at ordinary income. I'm going to ask a question here. If you know you're going to be taking distributions and you know that based on all estimates, you're going to be in a higher tax bracket, wouldn't you rather pay less taxes on some of that money now instead of paying more taxes later? So for example, if you know that all the money in your IRA is going to be taxed at some point, and we have this window where, let's say Mary is currently 65 years old, and she's going to have to start taking RMDs at age 72. And we know right now she's only making 50,000, and we could take another $36,000 out as a distribution, and she's only going to pay 22% on that money instead of paying 24% or more later on. That's the advantage of knowing your tax bracket and how much you could take now, even if you don't need it. All you're doing is reinvesting it and saying, you know what, I'm paying less tax on this IRA distribution than I would when I'm 72. And now it's growing tax deferred or tax free in certain scenarios. And when I want to take it out in the future, I can with a less tax impact. Or when I pass away, my kids inherit it tax free with a stepped up cost basis or through a Roth IRA where they'll have no tax. Right. So there's different ways to look at that from a tax planning perspective if you're currently not taking your RMD yet. Okay. If you are taking your required minimum distribution, right, we have a little bit less of an option with regards to some of the tax planning. You want to do that on the forefront or ahead of time. What if you don't take your RMD? Right. And I've run into this where a lot of people will say, you know, I really don't need this money. I've got, let's say, a husband and a wife, and they both have pensions and they both have Social Security. And they're saying, oh, it's just going to cost us more in taxes. Right. We don't want to take it. Well, partially they're right. They are going to have to pay more in taxes. But in the eyes of the IRS, they're also getting more money. The frustrating part is they've saved all this money all these years. And now they're at a point where they're saying, you know, I don't want to take it, but I have to. Okay. If you do not take your required minimum distribution, it's a 50. So a 50% penalty that they're going to charge you. So for example, with Mary, if she had to take a $50,000 required minimum distribution and she said, I'm not going to take it. If she's audited and caught, she will owe a $25,000 tax penalty to the IRS for not taking that required minimum distribution. So they're very serious about it, right? They're very serious about it. If you forgot to take an RMD, right? And it happens, right? I've met with clients where they're like, I just didn't know. If you forgot to take a required minimum distribution, you just need to let the IRS know right away. So work with your CPA. They can notify the IRS. They can do the withholding and the distribution right away. Submit a document explaining why it was missed, right? So basically you're saying, my bad, I forgot. Here I'm doing the distribution. You're getting the tax dollars and you're detailing the reason why you forgot. Maybe you were still working. Maybe you were dealing with a lifetime crisis. Maybe you just didn't know, but you're detailing the reason. And typically in those examples, right, the IRS is very lenient saying, hey, you did the withholding, we got our tax dollars, all is good. But you'd want to work with a CPA right away to get those distributions taken out. Okay. The third piece that I want to touch on is not all investments are created equal. So when you're talking about RMD planning specifically, right, required minimum distribution planning, the one thing you have to take into account that's different than when you were investing when you were younger is you're going to be forced to take money. You're going to be forced to take distributions. In year one, if we look at the table that we had described before, you have to take out a 3.9% distribution from your account. One thing that's ingrained to us is the older we get, the more conservative we should become. And I'm not telling you to be overly aggressive. That's not what I'm saying at all. But we can also get to a point as investors where we're too smart for our own good and we'll become too conservative. So when you become too conservative, for example, let's say for the last 10 years prior to interest rates starting to go up here, let's say that you had your IRA in a CD, right? What would a CD get you right now, right? Or even over the last 10 years, maybe 1%. So the reason that an individual would invest in a CD at 1% is because they want to protect their principal. This is where we can get too smart for our own good, and we have to look at things differently. When you hit the age of 72, the IRS is saying that if you have an IRA or a 401k or any pre-tax money, in year one, you have to take out a 3.9% distribution. You have to. If you don't, it's a huge penalty. So what you do is you take 3.9% of your CD out, pay taxes on it, and they're putting it into a checking account with little to no interest. Well, if you're only getting a 1% return and you have to take a 3.9% distribution, you just guaranteed yourself a 2.9% loss of principal. And that's the exact opposite of what your goal is when you bought that CD. So you cannot be so conservative in retirement and when you hit RMD age that you can't keep pace with the required minimum distribution that you have to take out. Otherwise, you're literally guaranteeing yourself that you're going to spend down your principal. So think about it. Every year you get older, if you divide a number by a smaller number, the percent that you have to take from the account goes up every single year. So in year one, you're forced to take a 3.9% distribution. Then it goes to about 4.2, 4.5, 4.8. The older you get, the larger distribution you have to take because you owe taxes on that money. And if your returns cannot continue to keep pace with that or keep pace in some capacity, you're just diving into principal year over year, right? Which is not a good practice. Nobody wants to spend down their principal. In addition to that, a term that I want you all to write down is yield. Okay, yield becomes very important when you're getting ready to take distributions from any account. Okay, yield by definition is the amount of income that's generated without selling anything. So I'm going to say that again. Yield by definition is the amount of income that is generated without having to sell anything. So for example, right, dividends are a form of yield, right? Interest, capital gains, all those things. Remember, we're talking about pre-tax IRAs here. None of those are taxed until you take something out. So it's okay to have a capital gain distribution inside of an IRA because it's not taxed till you take any money out. It's okay to get big dividends inside of an IRA because you're not paying any additional tax or anything like that until you take money out, right? So yield is the amount of income that's generated without selling anything. So one strategy that we look at with our clients is we say, how can we get a yield that can help pace the distribution of the RMD so we don't have to sell so much of the principal? So, for example, if you're in an investment, let's say you're just in a 401k, you've always been there, and you're just invested in growth oriented mutual funds. Okay. So you're invested in the Googles of the world and so forth. Okay. They probably don't pay a dividend or a yield, or if they do, it's very, very small. So what you're forced to do is you're going to own a number of shares inside of that 401k or inside of that fund. And every year, since they don't pay a dividend or a yield, you would have to sell in year one 3.9% of the total shares that you own so you can satisfy your RMD. And this is where the market going up and down becomes a huge concern for retirees, because ultimately, if the market's up, that's a good thing because the stock price or share price is worth more money. You would need to liquidate less shares at a higher price to equal the 54,000 you'd have to take. If the share price drops, you're now liquidating even more shares than you were before because the share price is worth less. And if you have to take out 54,000, you have to sell more shares at a smaller price to cover that discount. So for example, 2022 is a prime example of how retirees can get themselves in trouble and multiply their losses, for example. Remember, we're calculating the required minimum distribution on the December 31st value. Well, on December 31st, the Dow this year was close to 37,000. Right now we've saw about a 20% pullback in the market. And if people are taking out their distributions for their RMDs, they're selling more shares because the accounts are down. That's why the yield is so important. So the yield is a form of income. Let's say that your yield or dividend in this example was 3.5%, which is very achievable. If you had a dividend or a yield of 3.5%, and in year one, you had to take a 3.9% distribution for the required minimum amount, you actually only have to liquidate about 0.4% of your shares instead of almost 4. So think about that, 0.4% of your shares instead of almost 4% of the total shares you own. So that means when the market goes back up, you have more shares, you can see bigger gains. You're ultimately limiting the principal that you're taking distributions from, and you can still continue to get those dividends going forward. So yield becomes extremely important as you're preparing for required minimum distributions and taking distributions anytime in retirement. So that's what I had set aside for today, right? The 3 takeaways that I want you to have is, number one, everybody who's over the age of 72 has to take a required minimum distribution if they have pre-tax money. Okay. There's a right and a wrong way to approach it and plan for it. You want to make sure that you're tax planning ahead of time so you can be as efficient as possible with all of your portfolio. And then number 3, not all required minimum distribution not all investments when looking at required minimum distributions are created the same, right? So we need to focus on making sure you're not too conservative. You can still be conservative, but ultimately you can't be too conservative that you're spending down principal. And number 2, yield is exceptionally important because ultimately it can help replace some of the income that you need to take out without having to sell down or spend down your principal. And that becomes very, very important from that regards. I'm going to stay on here for about another 3 or 4 minutes. If any of you have questions, just at the bottom, you can either click the chat feature or you can click on the Q&A feature. And I'm glad to go through any of those questions specifically if you have something that you'd like to ask. Oh, looks like we got a couple questions popping in here. Number one, does everyone need to take an RMD even if they're still working? Okay, that's a really good question. So basically, if you're still working at age 72 and you're still adding to a 401k, still adding to an account, and you're not a 5% or greater owner of the company. Okay, so if you work for Walmart, for example, and you're 72 years old and you're adding to your 401k, they won't require you to take distributions from the account that you're adding to. Okay, because you're not more than a 5% owner of that company. But if you have an IRA outside of that, right, that's not in your company sponsored plan that you're contributing to, you would need to take a required minimum distribution from that account. So that's a caveat. So it's the 5% rule. If you're greater than a 5% owner of the company, they're doing that because ultimately, if you were a small business owner, some people will work forever or be on payroll forever, and they're trying to avoid somebody just avoiding their required minimum distribution. Another question just came here. So wait or take our RMD now. What are chances of getting a better yield this year to cover the RMD? Well, that's a loaded question there. So I've been getting this a lot, right? Pull out the crystal ball here. So wait or take the RMD later. What are the chances of getting a better yield this year to cover the RMD? So your yield is different than your return. That's the main piece you need to look at. So if you've got the yield that's covering the bulk of the distribution. So let's say in the account, you're getting a dividend of 3.5%, right? Just like we had talked before. If the amount you're required to take out is 4.5% and you're getting a 3.5% dividend, we really need to fill that 1.5% difference, or that 1% difference, excuse me, in that example. So timing is everything, right? So we look at it and we say, how can we limit the downside, right? Meaning that if the market's down, we don't necessarily want to sell something because we'd have to sell more shares. And we know right now the market's down. So human nature is to say, you know what, let's wait and see if it comes back up. And it could. And that's a good strategy in many places, but it also is an unknown. It could go lower before it goes higher. So in that example, what you would want to look at is your individual holdings you have and say, what could we liquidate that doesn't have a lot of bearing on market movement? So for example, if you had some short-term bonds or treasuries in your portfolio, they're not going to have a lot of movement on the downside or the upside. So if we liquidated those, right, we're not liquidating something at a low, and we're holding all the assets that as the market comes back up, they would appreciate faster, and they would have no bearing on basically the outcome of where we end up post-recovery. So in that example, to take the market timing out of it, you would actually look at the individual holdings you have, say, what can we liquidate that is not dramatically down because of the market, the economy, and so forth that we're seeing. And that's what we would pull out regardless of it's now or later. If the market was through the roof like we've seen the last 5 years, what you're actually doing is saying, hey, what can we trim that's at the high? Because we can take our gains off the table, lock some of those in. And if you're selling it at a high, you have to sell less shares than something that would be selling at a lower price. So I hope I answered that okay, but it would be more niche focused right now with the volatility we're seeing. All right. I don't see any other, oh, here comes one more question here. So one more question that came through is ultimately, okay. When do the new IRS formulas take effect? January 24th, 2022 article. Oh, this is Larry. Larry, I got your answer on this, my friend. We were talking about this during your faithful watch here. So basically what they're doing is They have the old IRS table. That uniform table that I showed you is the updated uniform table. Okay. So if you were taking your required minimum distribution, meaning that prior to 2019, you were already 70 and a half years old, they had a different life expectancy. So to make everything uniform, what they're doing is basically saying we have one uniform table. These are the numbers going forward. And those are the numbers that I shared with you. So at age 72, you're required to take a 27.4 life expectancy number into your equation. Prior to 2019, when you were age 70 and a half, the uniform life expectancy table showed you taking a 27.4 life expectancy distribution at age 70 and a half. Now it's age 72. So Larry, to answer your question, they're already in effect. The numbers I showed you on this ultimately are reflecting those updated numbers that they've changed those to. And that's a benefit. It's a 6.5% savings to individuals by them moving those numbers back to the age 72 being at the 27.4 life expectancy. So really good question. With that being said, I'm going to go ahead and end this. If you guys have any questions, please feel free to reach out to myself or to one of our advisors here on the team. As a gift here, if you'd like, we're giving away our books. So 8 Things I Wish I Knew Before I Retired. If you'd like a copy of that, please shoot an email over to myself or to the company and just type in 8 Things I Wish I Knew, and we'll go ahead and get you one of those signed copies from Rock and myself. But that's my gift to you guys for attending the webinar. Please also give any feedback on these or anything that you would like to be educated on as well going forward, as we're happy to share these, and I really appreciate you taking the time. So have a great rest of your day. Look forward to hearing from all of you. Take care.